Welcome to Subramani. Um we have been penalized a lot, at least not so badly in India, but in the US, for keeping money in cash. You were getting 0% and minus and things like that. But today, you can get up to 5% in US Treasury, which is not a bad rate at all, which means you can get something like 7% in Indian Treasury, 7.5% in Indian Treasury, and you can get about 9.5% in good quality Indian paper. So on that, if you have to pay 30% tax, that hurts. But yes, that kind of return you can get. So it's not a bad place to keep your cash. So should you keep your cash in liquid funds? Should you keep your cash in ultra short bond funds or equity savings fund, where I'm expecting to get something like 6-7%, maybe 7.5% for an exceptionally well managed fund? Should you keep it there or should you keep it in equity? My take is, if you are going to draw down the money in the next 5 years, you're better off being in an equity savings fund. But even while putting money in an equity savings fund, please understand that the amount of uncovered equity is going to decide on the return that you get. So if a fund has 15% uncovered equity, it is going to perform a little more like debt fund. But if it has 35% in equity, it is going to perform more like a balanced fund. So be careful about where you're putting your money. And also understand that all the equity saving fund past returns, when you're seeing it in a bull market in the equities. If the equities turn into a bear market, your equity savings fund will give very poor results and pathetic results. But keeping money there, you are at least saying, okay, some portion of my money is participating in the equity. So that is good. However, if you have got a strict thing, like your daughter is in class 10 and you think you want the money when she is in class 12, that's a strict stop, right? You need it exactly in 2026 or 2027, whatever. That kind of money, maybe 70% goes into debt instruments and only 30% remains in stock, or maybe only 15% remains in stock. So that money should go into a equity savings fund, and perhaps you start doing an SWP exactly 1 year from now, or maybe withdraw the whole thing 1 year from now and put it into a bank deposit or even a savings bank account or a bank FD, which you can break whenever you want. That is the kind of discipline you need, and at least now you're getting a decent return for your cash, right? US markets were worse, but now at least US markets, Indian markets, everybody is giving you some decent money, return on your cash. So it's not a bad time at all. Though of course the whole market looks very attractive. Look at the Magnificent Seven, right? Magnificent Seven in the US. It's gone through the roof. There are funds which have given 21% return. There are funds which have given 53% return, right? I think Cathy Wood's scheme, Cathy Wood's fund is up 21%, and some FANG Plus is up 53%. So do the Magnificent Seven look attractive? Yes, of course it looks attractive. Does the cash look good compared to that? I think so, yes, because you're going to look for risk adjusted return, and yes, you can get the US market at a PE of 19, you can get the Indian market at a PE of maybe 19, 20, whatever, maybe 22, that's the PE that's going on. Is that what you are going to chase? Is it worth chasing that today when cash has a price, right? Cash is not free. I don't know, that's a call that you have to take depending on how much of capital preservation you're chasing and how much of money you want in the next 4-5 months, 4-5 years, 3 years, 4 years, when you won't need to use the money. So I would think a big portion of your money should be in a fund, equity savings fund, where there is only 15% exposure to equity and a 50% arbitrage, and the remaining in debt. Even if the portion of the remaining is in gold, I wouldn't mind so much, but yes, something with less in equity, simply because one can expect the equity to do badly. However, even if equity were to do badly, 85% of your money is going to give you debt-like returns, which would be in the region of 7-8%, maybe 9% if the arbitrage opportunities are good. So with that kind of an expectation, should you be in debt funds? Maybe you should be in debt funds. Will you have to pay tax? Sadly, yes, you will have to pay tax. Not long ago, we were getting tax-free returns in debt, right? So I have money in some long bonds, which are 2045 maturity and 2055 maturity. So at maturity, I will get that money at 20% taxation with indexation. So I'm happy taking the money at that stage, right? So at least till 2045 and 2055 I need not worry about tax, and for all you know, tax structure could change by that time. Of course I could drop dead and my daughter could get that money, but I'm just saying, so when you take a longish call on taxation, well, you can do that, but can you do that today? No, because all that money will be taxed in your hands the day you receive it. I'm still doing a small SIP in a fund with a 2045 maturity, hoping that if some things change, that will be attractive. But if it doesn't change, I'll pay the tax at least after 20 years instead of paying the tax now. Thank you.